We're here at NewEdge Aligned with Travis Lazareff and Greg Poole. Greg, thanks for
Hey,
being here.
thanks for having me.
Yeah, so I wanted to really talk through about your career, how you ended up on the wealth management side. I know you started on the asset management side. Maybe give us a little start of how you started in
Yeah.
the asset management business.
So I had always loved stock market as a kid and spent a summer in college at Standish Air and Wood in Boston, which is a small asset manager, and ended up going to consulting for a bunch of years, but said, you know what, if I could make a living, investing in the stock market, I would. And so I went back to Wharton, really specifically with that in mind. And Wharton had an amazing finance program, and they had a program called the Fellows Fund where students could manage a piece of the portfolio, a little piece, but you were pitching stocks. And it was a great community of people that just loved the stock market. And so I knew that's what I wanted to do. And when I get out, I was lucky enough to get a job at Wellington in Boston, launching a fund with some fantastic investors who brought me on board.
When you started in that business, what do you think was the biggest push for you to be successful? What drove you to kind of want to be in the stock market? I believe you started in large cap stocks. Is that
Yeah,
true?
so that was at that time it was all cap. I worked a little bit on the Wellington fund, which was large cap, and then we also launched a hedge fund, which was really all cap. And at that time, I was doing a lot of small cap stuff. And at that point, the market was totally different than it is now. So it was 2000, and it was pretty inefficient. There weren't so many people doing it. You could find companies that were really well run companies doing interesting things that no one cared about. You'd go to a conference and you'd have a meeting with the management, there'd be two other people. So, you really did feel that kind of getting out and looking hard and scouring and building models, you could have an edge and you could find undiscovered companies and you'd make an investment. And over time, they tended to do well. I'd say, the nature of the business changed a lot. It became much, much more competitive. Information became ubiquitous. The number of analysts, the number of quantitative firms, it became much, much harder, to have an edge. And so, I'd say after a couple of decades of doing that, I really thought it was time to do something different. I still loved markets. I loved investing, but I wanted to have something that was a little more advisory in nature where I felt like I was making more of an impact on an individual.
And so it kind of ties in your consultant days to your
Very
stock market
much.
days and really, I guess, how did you meet Pat? How did you guys kind of form this partnership and how did
Yeah.
you transition to the wealth side?
I mean, it was very organic. Pat actually and I were friends, 7 years ago, well before I thought of doing anything else. Pat was actually a client of one of my partners at Wellington, and when I moved down to Miami, my partner introduced Pat and myself, and we became just friends. He's, everyone who knows Pat knows he's a super welcoming guy, and he knows everything about Florida and Miami, and so we spent a lot of time playing golf. He was picking up golf, I was picking up Miami and trying to figure things out, and we just became friends. And as I kind of leaned on him as I was thinking about what I wanted to do and was leaning towards doing something in the advisory space, he was just a great thought partner. And I had a bunch of different opportunities and I was running them by him. And I think after a while, he came to the conclusion, which was, hey, what you're trying to do and what I'm trying to do are really similar. The vision that he had for really building a fiduciary, high tech, low cost, no conflict model was really where I wanted to land. And ultimately, we came together and said, hey, maybe we should try to do this together.
What do you think is the biggest similarity and differences between you and Pat? Because there is differences, there are similarities, and I think what drew me to you guys was the fact that you had the two separate pillars that all kind of came together, and
Yeah.
they're called the yin and the yang, if you
Yeah.
will.
I mean, maybe I'll start what's similar. I'd say, we are really looking at investments all the time and thinking about, what fits in to an individual's portfolio needs and their risk tolerance and their goals for return. But I'd say much more of the focus that I put on now is really on kind of what's beta and what has a chance of being alpha. And in the fund business, it's kind of all about alpha. You're always trying to generate alpha. Your performance, your pay, your career is based on the alpha. I think the view that I bring to the table now is, look, alpha is really hard to generate. And, arguably in some markets, I don't even think it's possible to consistently generate alpha. And therefore, we really shouldn't be paying for that or spending a lot of time trying to find it. And so, kind of with that mindset, we're spending a lot of time looking at all the different asset classes. I was primarily focused in equities at the time. In the hedge fund, we did some fixed income and derivatives, but mostly equities. Now we're looking at all kinds of asset classes and trying to figure out, where is there a chance for alpha? And if we think it's a beta market, then what's really the simplest, lowest cost, lowest tax structure that's also being invested well, but where we're not trying to generate alpha. We're trying to really be the market, but very low cost, very simple, and very, tax efficient. And then for the areas where there is alpha, where do we believe that could be? And as we talk a lot, that's often we think in seed venture. It might be in, smaller private equity or smaller real estate opportunities. And there we're meeting a lot of managers and we're making decisions. But again, much more than trying to sort of say, hey, this investment is going to generate alpha. It's more where are the asset classes, where is alpha available, and where is it not?
So you can really look at it, I would say, a bottom up, top down approach. You have that bottom up fundamental approach. Pat takes the top down wealth management viewpoint of having 20 plus years in that business. And together we're able to really create a viewpoint that's going to help pass down generational wealth. Is that a good way to frame
Yeah.
it?
And I think Pat's background and my background are super complementary. He has actually incredible vision on a lot of fronts, not just in the, I'd say, industry that we're running from a business perspective, but also from an investment perspective about where things are going. And I obviously have a lot of experience kind of really breaking things down and going deep into things. And so I think when you can combine that sort of very high level, long-term view that's really differentiated because he's not just a linear thinker like I am. He kind of thinks quite, I think, out of the box and creatively with kind of my ability to really dig into something and tear it up. And you put that together, you can get some really good outcomes.
I think when I met you guys, when I was doing the due diligence for the family office and saw what you guys were doing, I think it was immediate that I told Pat that I really wanted you guys to be my mentors because of that approach and that vision we have for building aligned and how things are going to look. I'm excited and thank you for sharing your story. And
Yeah, well, we're super happy to have you, and I think we love to teach and we love to mentor, and we're excited to kind of bring you along and watch you develop. And we do the same thing for young folks who are, our clients and the children of our clients is really, we believe very strongly in what we're doing. It's not the only way, but we really think the way that we go about the process works.
I think you just touched on something really important is about not just first generation, but second generation. And I know Pat and I have had the same conversation, but I mean, how do you think about structuring as AI is coming into the fold? How do you structure kind of the next generation, how we think about investing for that next generation for families?
Yeah, I mean, I think the one thing that we keep coming back to is diversification. I think, obviously the way that people get the wealthiest is not diversifying, right? They take a huge bet and that bet turns out to be right. I think, as we think about, wealth and transferring wealth to the next generation, I think the ability to make money is still very high, but the ability to lose money, I think, is as high as it's ever been. And sort of the rapidity of change and obsolescence in a business that you thought was really well positioned that all of a sudden 6 months later is not have no place in the market is really scary. And so I think it really means like we try to have a humility. We have our views, but we try to have the humility, which is that we really don't know what's going to happen. We don't really think anybody else knows what's going to happen. There's going to be some massive winners, but there's also going to be a lot of massive losers. And so let's really try to take an approach that's diversified enough that if we are bullish, because we really are bullish in what technology and AI is going to do for the opportunity set to build businesses, to create value, but we want to make sure we get that. And by being kind of too narrow and targeted in our bets, while we could win big, we could really lose big. And so again, you're trying to take wealth and keep that wealth onto the next generation and pass it on to build. I think having diversification across all these asset classes and within the asset classes makes a lot of sense.
It's a great service to our clients because I do think out there we see people chasing alpha, and sometimes, to your point, things have become so efficient that it's hard to find that alpha. And I think the way we're approaching it, to your point, is not the only way, but is from our viewpoint the best for what's going to be coming in this AI wildfire age, as
Yeah.
Pat says. So,
Yeah.
well, thank you for this. I'm excited. I know you're excited what we're
Yeah.
building, and it's great to be with you
Yeah.
and you and
Great to
Pat.
talk.
Yeah, absolutely.